Bitdeer Technologies Group missed Q2 2026 EPS consensus with a 37-cent loss per share. Revenue came in at $228.8 million, which is up 47% year over year. Guidance was revised, pushing full-year crypto mining CapEx up to a range between $200 million and $280 million. The stock reaction. Shares plunged 20% in the session, closing near $9.09, despite a brief pre-market bump.
Yeah, it was an absolutely brutal session. I mean, it completely wiped out that early morning optimism we saw the second the print hit the wire.
Right, and that violent swing is exactly why we are doing this today. So for this deep dive, we're pulling from a pretty heavy stack of sources. We've got the official Q2 earnings transcript, company press releases, and analyst notes from Benchmark, Zacks, and Koala Gains. The goal here is to unpack this earnings report for you, the retail investor, navigating this, this wild volatility.
Definitely. Because the central question staring you in the face is, how does a company grow its revenue by 47%, announce a massive $4.7 billion AI infrastructure contract, and then just watch its stock get completely taken to the woodshed?
Yeah, exactly.
Well, we're really looking at the ultimate paradox of hypergrowth infrastructure companies here. Like, you can print the best top-line operational metrics in the entire industry, but if the underlying unit economics and the balance sheet trajectory terrify the market, the equity valuation is going to collapse.
Yeah, so let's start with the operational engine that actually generates their cash right now, which is the Bitcoin mining segment. Looking at the numbers, the scale they're achieving is, honestly, it's staggering. Bitdeer's self-mining hash rate surged 342% year over year.
Which is massive.
Right. They are now sitting at 73 exashash per second. They've got 243,000 active mining rigs plugged in and running, which is a 113% increase in their fleet size. And the actual output followed suit. Bitcoin production jumped 377%, pulling in 2,694 Bitcoin during the quarter.
Yeah, and those operational leaps, they place them firmly in the top tier of publicly traded miners globally. I mean, deploying over 100,000 new machines and integrating them into global power grids requires just immense logistical execution. Hitting 73 exashash essentially means their facilities are performing 73 quintillion mathematical calculations every single second just to secure the Bitcoin network.
Okay, let's unpack this, because this is where the retail investor reading the headline numbers starts, pulling their hair out. Despite that massive top-line operational growth, despite 73 quintillion calculations a second, the company posted a gross loss of $8.5 million.
Yeah, that's the kicker.
Right. That equates to a negative 3.7% gross margin, which is a stark reversal from the $12 million gross profit they posted a year ago. It feels like, I don't know, it's like buying a fleet of Ferraris to drive for Uber.
That is a great way to put it.
Your revenue skyrockets because everyone wants a ride, but the rapid vehicle depreciation and the massive monthly car payments end up eating you alive. If they are mining almost 4 times as much Bitcoin, why are the margins bleeding out?
Well, what's fascinating here is that the mechanics of the Bitcoin network actually guarantee that margin squeeze if you aren't careful. The bleed is really being driven by 2 relentless forces, which are depreciation and electricity.
Okay, break that down.
Sure, so let's look at depreciation first. When Bitdeer brings those new active rigs online, they have to recognize a massive amount of depreciation expense on the accounting side. Mining hardware is a depreciating asset tied directly to the global network difficulty.
And I want to pause on that for the listener, because network difficulty is sort of this invisible force crushing these margins. The protocol automatically adjusts the difficulty of its cryptographic puzzles based on how much global computer power is plugged in, right?
Exactly.
So as competitors bring more machines online, the math gets harder.
That is the core mechanism, yeah. A mining rig that produced, say, 1 Bitcoin a month last year might only produce a quarter of a Bitcoin this year, simply because the global network hash rate climbed and the puzzles became more complex. Right? So that renders older machines effectively useless. They become heavy paperweights that consume more in electricity than they actually produce in digital asset value. So companies are forced to aggressively write down the value of that hardware.
Man. And then you add the second force, which is the electricity itself. Because they noted a slightly higher per unit power cost in this quarter.
Yep, exactly.
So when you combine the heavy accounting depreciation of bringing 243,000 rigs online with elevated industrial electricity rates, the cost of operating simply overtakes the revenue gain from mining the extra Bitcoin.
It does, but, Looking closely at the operational data reveals a critical silver lining that management is really banking on here. Their overall fleet efficiency actually improved by 39%, dropping down to 15.8 joules per terahash.
Oh, okay. Explain the mechanics of that metric because 15.8 joules per terahash sounds pretty abstract, but I know it dictates survival in this industry.
Yeah, it absolutely does. Joules per terahash measures exactly how much electrical energy is required to perform 1 trillion calculations. So a lower number means you're doing the same amount of computational work while pulling significantly less power from the grid.
Got it.
Improving that by 39% is a massive operational leap, and it's largely due to the deployment of Bitdeer's proprietary seal miner hardware. Instead of constantly buying rigs off the shelf from third-party manufacturers, they're designing their own custom silicon.
Ah, I see.
Yeah, achieving 15.8 joules per terahash gives them a structural physical cost advantage. Their machines can remain profitable even when network difficulty spikes or energy prices fluctuate.
Right, but the market clearly looked at that $8.5 million gross loss and decided that structural advantage wasn't saving the balance sheet fast enough, which provides, I think, the perfect logical transition into management's aggressive new strategy.
Oh, absolutely.
Mining hardware depreciates, and the margins are getting squeezed by network difficulty. But what doesn't depreciate is a 3-gigawatt global power portfolio. Bitdeer has secured massive amounts of grid connectivity, and they're leveraging that to pivot hard toward high-margin AI infrastructure.
Yeah, finding a more stable, lucrative way to monetize those industrial power assets is really the defining trend in the crypto mining sector right now.
Yeah.
I mean, training artificial intelligence models and running massive data centers requires exactly what Bitcoin miners have spent the last 5 years securing.
Which is vast amounts of reliable, high-density, grid-connected electricity.
Exactly.
And that brings us to the blockbuster announcement dropped right before earnings, the Tidal mega deal. They signed a 16-year co-location lease at their Tidal Norway campus with a company called Volta. Let's look at the sheer scale of these numbers.
Let's do it.
It represents $4.7 billion in contracted base term revenue to configure 121 IT megawatts of power specifically for NVIDIA GPUs. And there's an 8-year extension option baked in that could push the total lifetime value to $8 billion.
Yeah, I mean, it is a transformational contract that forces Wall Street to take them seriously as an infrastructure player. It establishes AI colocation as this massive standalone pillar of their business.
Right.
And they're also seeing real traction in their direct AI cloud segment, where annual recurring revenue hit $76 million with a 95% utilization rate across over 4,200 deployed GPUs.
Okay, but here's where it gets really interesting, because we need to separate the hype from the physical reality here. A $4.7 billion headline makes for an incredible press release. But that money is spread out over 16 years.
Right.
Aren't they kind of counting their chickens before they hatch? Especially considering they haven't actually built the physical infrastructure to support these specific NVIDIA GPUs yet.
It's a really vital critique. And
Yeah.
honestly, looking at the stock's 20% drop, it is exactly what the institutional market is focusing on. You cannot simply take that $4.7 billion and drop it onto the balance sheet today. We have to dissect the actual mechanics of a colocation lease to understand both the upside and the bottleneck. In a colocation deal, Bitdeer is not buying the expensive NVIDIA GPUs. They are building the reinforced facility, installing the industrial liquid cooling systems, and managing the massive electrical transformers.
They are essentially a highly specialized landlord.
That's exactly it.
And the power structure of that lease is the real prize here, correct? Management highlighted the pass-through structure for electricity costs.
Oh, yeah. That is the holy grail for a data center operator. In a pass-through structure, the tenant, in this case, Volta, absorbs the cost of power fluctuation.
Oh, wow.
Yeah, so if energy prices in Norway spike, Volta pays the difference. This completely shields Bitdeer's margins from energy price volatility. They secure a highly predictable contracted cash flow over 16 years, fully insulated from the commodity market shocks that, routinely devastate Bitcoin miners.
I see the appeal of the predictable cash flow, but let's confront the bottleneck. To get that cash flowing, they actually have to build the site. According to the transcript, Bitdeer needs $500 million in remaining capex just to finish the Tidal campus for Volta. They estimate the cost is about $4 million per critical IT megawatt.
Yeah, the execution bottleneck is daunting. Transitioning from a crypto mining site to a A Tier 3 AI data center requires stripping a facility down to its bones. You have to install incredibly expensive redundancy systems, backup generators, advanced cooling, fiber optic lines.
Yeah.
It is just a wildly capital-intensive pivot.
Which is why that $500 million CapEx requirement perfectly explains the financial reality of this quarter. When you stack those future capital requirements up against the current balance sheet, the 20% stock plunge suddenly makes complete sense. We really need to run these numbers.
Therefore,
Q2 net loss widened to $92.3 million. Now, adjusted EBITDA, which strips out those non-cash depreciation charges from the older mining rigs, did jump 575% to $31.1 million. But look at the debt load.
yeah, the debt load is heavy.
The balance sheet is holding $1.8 billion in long-term debt against just $496.3 million in cash.
And $500 million in cash sounds robust in a vacuum, you know? But when you are carrying $1.8 billion in debt, running a business that just posted a $92 million quarterly net loss, and you have a $500 million construction bill due for just one of your AI campuses,
Yeah.
that cash buffer evaporates very quickly.
Very quickly. Which exposes the direct catalyst for the stock crash. Amidst the revenue beats and the $4.7 billion AI headlines, Bitdeer quietly filed a $1 billion at-the-market, or ATM, stock offering program.
Yep.
And I have to address you, the listener, directly here. If you are a retail investor reading these filings, you have to look at the massive gap between management's words and their actions.
It's pretty glaring.
Right, because management stated on the call that they intend to use project-level debt financing to fund the title build-out, but they simultaneously file a $1 billion ATM. Is this bait and switch regarding dilution what actually spooked the market?
Oh, absolutely. If we connect this to the bigger picture, the ATM filing is absolutely what caused the sell-off. The market loathes uncertainty, and it severely punishes equity dilution. We should probably explain the mechanics of an ATM program.
Yeah, please do.
Unlike a secondary offering where a company sells a massive block of shares all at once to an institution, an ATM allows the company to slowly drip newly created shares into the open market during daily trading.
Ah, okay.
It is a highly effective mechanism to raise cash, but it directly dilutes the ownership percentage of every existing shareholder.
So they're essentially using their own stock as a credit card to pay for the concrete and cooling systems in Norway. And existing shareholders have already faced a staggering amount of dilution. The share count has expanded at roughly 38% over the past year alone.
Exactly. Investors are simply doing the math. They are weighing the highly predictable long-term cash flows from the Volta deal against the immediate, severe cash burn required to build the infrastructure. Management can talk about securing project-level debt all they want, but holding a $1 billion equity dilution mechanism in their back pocket signals that debt might be too expensive or too difficult to secure. The fear is that Bitdeer will lean heavily on that ATM, consistently watering down the stock price just to keep the construction lights on.
So what does this all mean for their broader strategy? They're attempting to build the infrastructure of tomorrow, but they have to survive the cash burn of today to actually see it.
Right. Yeah.
Management is defending this highly capital-intensive dual-track strategy to Wall Street by pushing a narrative of complete vertical integration. They don't just want to mine Bitcoin or lease data centers. They are trying to own the entire physical supply chain.
Vertical integration is really their defense against the volatility. For example, they highlighted the ongoing construction of a 187,000 square foot facility in Sparks, Nevada.
See, I am struggling to understand the logic of that specific project. They're bleeding cash building data centers in Norway, but they're also building a massive manufacturing plant in Nevada to build their own seal miner units.
Right.
They want to produce 10,000 custom ASIC machines a month by the end of 2026. Aren't they just trading hardware markups for massive factory construction costs?
Well, from management's perspective, the long-term math justifies the upfront factory cost. Historically, miners have been completely at the mercy of third-party hardware vendors like Bitmain or MicroBT.
Oh, right.
Yeah, and during a crypto bull market, those vendors astronomically inflate the price of mining rigs. So by manufacturing their own ASICs in Nevada, Bitdeer bypasses that price gouging.
That makes sense.
Right, it protects their supply chain and fundamentally lowers their capital expenditure per exahash over the next decade.
But the execution risks multiply with every new project they take on. Building a custom chip manufacturing facility in Nevada is a specialized endeavor. Constructing an AI data center in Norway is a specialized endeavor.
Absolutely.
And on the earnings call, they flagged specific physical risks threatening their timelines. They are currently facing a lawsuit from a neighboring company that is threatening the development of their Clarington, Ohio site.
Yeah, that lawsuit highlights a massive, under-discussed bottleneck in this industry, which is local zoning and grid interconnection.
Oh, interesting.
When you attempt to build hundreds of megawatts of infrastructure, you run into municipalities fighting the noise of the cooling fans, local businesses contesting the massive draw on the power grid, and, environmental impact studies.
Right, of course.
Every single legal delay pushes those future AI cash flows further out into the future, which subsequently increases the near-term cash burn and the likelihood of them tapping that ATM.
So how are the financial analysts interpreting this incredibly complex matrix of operations? Because we have some sharply diverging opinions in the source notes.
We really do.
Benchmark reaffirmed a buy rating with a massive $22 price target. They are operating on the thesis that the Bitcoin mining business generates enough cash to pay the bills while the AI colocation business scales up. But Needham was noticeably more cautious.
Yeah, they were.
They cut their target to $20, specifically citing a less robust pipeline outlook than they previously modeled.
The analyst community is deeply divided on how to value these hybrid companies. Benchmark looks at the $4.7 billion Volta deal and concludes that if management simply executes the build-out, Bitdeer is a severely undervalued AI infrastructure play.
Right.
They view the 243,000 mining rigs not as a long-term strategy, but as a necessary cash-generating bridge to keep the company afloat until the AI revenues take over.
I see.
But Needham, however, is looking at the Clarington, Ohio lawsuit and the $500 million CapEx requirements, and they're factoring in severe execution delays.
Which raises an important question about the fundamental identity of the company. Are they trying to do too much? I mean,
Yeah.
they're designing custom silicon chips, mining Bitcoin at an industrial scale, building factories in Nevada, and acting as a colocation landlord for massive AI labs in Europe.
Yeah, and that identity crisis is the exact source of tension we're seeing among the institutional shareholder base right now. There's a very vocal segment of investors who want Bitdeer to drop Bitcoin mining entirely. Oh, yeah. They look at the negative gross margins, the constant hardware depreciation, and the post-halving network difficulty, and they want out. They want the company to focus exclusively on AI data centers.
Why is that?
Because Wall Street assigns much higher valuation multiples, often 15 to 20 times forward earnings, to contracted AI infrastructure cash flows. Conversely, the market assigns a much lower risk-adjusted multiple to volatile commodity producers like crypto miners.
So they want the company to be valued like a stable, vital tech utility rather than a speculative mining operation.
Exactly. But management's counter-argument is grounded in physical reality, which is that you cannot just flip a switch and become a pure-play AI company overnight.
Right, it takes time.
The mining operations are currently generating $228 million in quarterly revenue.
Yeah.
You cannot shut off that cash flow while you wait 2 years for a Norway data center to be permitted, built, and energized.
That's a good point.
Yeah, the mining operations, despite the punishing depreciation and tight margins, are the only bridge capable of funding the AI infrastructure of tomorrow without diluting the equity to zero.
And it requires a flawless Highwire Act. They have to keep their proprietary seal miner fleet efficient enough to generate positive cash flow. They have to avoid tapping that $1 billion ATM too aggressively so they don't enrage their existing shareholders.
Yeah.
And they have to perfectly execute a $500 million data center construction project in Norway while fighting zoning lawsuits in Ohio.
And if the price of Bitcoin drops unexpectedly or global energy costs spike, the margin of error on that Highwire Act vanishes completely.
Which leaves us with a final thought for you to mull over as we watch the real-time evolution of this new sector. Are hybrid crypto and AI companies like Bitdeer actually the ultimate diversified infrastructure play of the future? Do they possess the ultimate advantage by being able to dynamically shift gigawatts of power between mining Bitcoin and training AI models based on whatever yields the highest margin that day?
It's the big question.
Or are they setting themselves up for a spectacular failure by burning through cash on two of the most fiercely competitive, capital-intensive industries on the planet simultaneously? It is like trying to build a high-speed rail line while simultaneously running a highly volatile commodities trading desk just to pay for the steel.
Yeah, it is the defining gamble of the digital infrastructure sector right now. And honestly, the balance sheet is going to be the ultimate judge of whether they can pull it off.
Absolutely. We will be watching the SEC filings and the construction timelines every quarter to see if that massive gamble pays off. Make sure you follow the show for our daily earnings coverage so you don't miss the next deep dive.